Well, I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable where we talk about current market conditions and go over recent trades, go over the interest rates, right? Interest rates are breaking out. Hot CPI, PPI data, everybody talks about interest rates and potential rate hike. And versus AI, right? Strong earnings, resilient economy, who's going to win? For those of you who are new, welcome. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express. My background is in computer science, I have a master's degree. I love the AI, use it for coding, use it for building models, use it to write newsletters, answer customer questions. So very tech savvy. But after companies went public that I participated, like Options Express, MediaOcean, decided to manage my own money. And I've been doing that for longer than I'm willing to admit. Disclosures are very important. Please read them. If this is the first time you see these slides, I encourage you to visit optionscreen.com to understand the risk associated with trading stock and options. I'm not a financial advisor. You can pause this disclosures screen to read them. All right, let's jump into the market. All right, we have, kind of both. You can argue about bullish, right? You can argue about bullish, and bulls have an idea, bears have an idea, argument. So let's talk about that first. So if you zoom out, let's look at 1 week. Let's just summarize. If you look at the 10-year yield, you can see it's above 450, right? We broke through the year-to-date high in 2026 high due to the, again, escalation in the Middle East, high oil prices, blockade of Strait of Hormuz. It's causing the crude oil prices to be elevated, right, for a prolonged period of time, March, April, now May. And it's also, BJ Martin, thank you. And it's also causing the CPI and PPI data, right? We had inflation data coming in on Tuesday and Wednesday, and it wasn't, it wasn't good, right? Last time CPI year over year 3.3, now it's 3.8. Monthly, month over month, 0.6. And PPI came in even worse, right? 0.6 months over months, year over year, 6%. So high input cost, and people, I guess, were hoping that Trump is going to make some miracles in China and reach an agreement, reopen Strait of Hormuz, and everybody live in peace. Doesn't look like that's happening, right? At least not immediately. And interest rates now are reacting. It could be, again, keep in mind today's expiration. Equity options expires. Very large positioning was in May. There's still very large positions in June, so that's good. The June contracts are hedged well. And if you look at the SPX, we did break above 7,500, but did not break above 7,500, but we're still trading above 7,400, right? So if you look at the positioning for SPX, 7,400 is your support, right? And 7,500 is your overhead resistance. We're in the middle of this range, right? And you already see a large position build in 7,600, right? And keep in mind, again, a lot of volatility because May contracts are expired. I removed them on purpose, but if you look at the all positions, we're still trading in positive gamma 7260. As long as the market is above 7,300, 7,100, somewhere between 7,100 and 7,300, it's in green, right? Buyers will step in, right? Dealers will step in to be gamma and delta neutral. But first thing first, 7,500, you already have a high overhead resistance, and 7,600, and then 7,700, people building 7,900. On the downside, in terms of put position, 7,400, right? So 7,400 right now, people are positioned. I mean, there's some position at 7,300. Obviously, most of the position are these round strikes, 7,000. But for now, that's your support, 7,400. Overhead resistance is 7,500. So let's look at June expiration, right? May is expiring. Let's just can't really predict what's going to happen tomorrow, let alone July and August. But a lot of the wealth management are revising their end of year targets higher. There were 7,500. We're already at 7,500. So people pushing 7,800, 8,000. But let's talk about June, right? One standard deviation, we're in that 7,200 level, right? So on the downside, it could be 7,200. On the upside, 7,700, 7,650. So you have three scenarios that it's worth thinking about. Right, one is the so scenario one, we're trading up and away, right? Strong earnings, Intel hit a home run, Google hit a home run, Cisco, Google, who else hit a home run? Intel, right? So the world, Texas Instruments, not all AI stocks are equally treated, right? You have Microsoft that's underperforming. Software sector is still underperforming. So you have scenario number one where still, if your revenue justifies your investment in the AI and CapEx, then you have scenario number one, and we're going higher. So scenario number two, CPI and PPI data is harder than expected. Rates continue to grind higher. So we're kind of stuck in this range. I mean, maybe we'll get to 7,600, right? We're at 7,418. We were at 7,500 yesterday. So maybe we get to 7,600, 7,700. But we could also be at 7,200 if the inflation data continues to deteriorate. And we're in June, and oil prices are still above 100 end of June. Then at some point people could be concerned. And then oil prices go to 150, 200, right? Escalation in Middle East, and CPI and PPI data actually starts affecting the corporate earnings, right? You have scenario number three. Maybe we revisit 7,000, maybe below. So those are the three scenarios that are possible based on the current interest rates, war in Middle East, and AI. So how many of you think we're going to get to one? How many of you say two or in three? Anyone? Bill. All right. Two. Thank you. Renata, two. Welcome back. All right. So most of you said two. I agree. Two. I think pullbacks will be shallow. I believe that pullbacks are shallow. Today's volatility is probably A, market is overbought. B, China-US meeting is over. And C, expiration and high CPI, PPI, that it makes sense that we're pulling back. How long it lasts, I think short term and shallow, right? That's why I put scenario two. But we're stuck between the rock and the hard place, right? Or economy at least. So I don't think it's going to be one-way street. But it is higher highs, higher lows. Short-term market is overbought. It makes sense that it pulls back. So SPX for this week still made new highs, all-time highs, not that far from all-time high. You see, you can look at software names. IGV today is actually up today, right? IGV is up on the down day, trying to break out. If software starts breaking out, this is a good sign that, this is just a rotation, right? because of the high interest rates. But that's a positive sign. Microsoft, Bill Ackman is buying Microsoft. I'm joking, just investing. But what else? VIX is 18. I mean, still low. High yield is down, right? So I would concern the spreads are rising, right? Because of the fear of possible recession, rate hikes now. So I would keep an eye on high yield. Dollar slightly higher. I mean, crude oil are actually stable. They're not great, but crude oil kind of not going anywhere since the beginning of the conflict. Brent is not going anywhere, and gasoline futures are elevated. Obviously, they are elevated, but no new signal. Nvidia is going next week earnings, so it finally broke above that 200 level. It's up, significantly this week. People are taking profit. Copper, strong price action in copper, but reversed due to interest rates. Silver is down significantly, and gold is down significantly. So that's macroeconomic conditions. In terms of we had a lot of people today. Yay. In terms of the model, if you look at the stock forecast toolbox, it also shows you positive momentum. So 10-day prediction, positive momentum on stock forecast toolbox. Today is predicted 741.95. We are exactly at the predicted price. I give model an A, that it's doing a good job giving you support, resistance. And in 10 days, it shows you we're still in uptrend. The uptrend hasn't been broken. We were as low as 737 today, but if we close at these levels, I would say this is a win for the bulls. You can also enter your portfolio today. Again, semiconductors have a signals, LRCX. So you have a stock like LRCX. Is that up today, actually? No, it's down. That doesn't, it's delay quote. But I mean, it's down with the rest of the market, but still very strong uptrend. This is great candidate. If you want to buy in pullbacks, I would consider LRCX. NASDAQ was the other signal, and OKE, right? So you can enter your portfolio to watch. It'll give you predicted low, predicted high, and direction, right, for the next 3 months with the direction. So you can create your watch list. You can go to company screener and look at the long-term. This gets updated every month, long-term prediction. This was posted on May 1st. So you can see, obviously, computer hardware like STX, WDC is on strong uptrend. Some of the aerospace and defense sector are in uptrend. Semiconductors, very strong. Energy, very strong. So this shows you on May 1st which sectors have momentum. That doesn't mean the momentum lasts. Like aerospace and defense after the earnings actually pulled back. What is it like? JD and NOC, I think they're down significantly after our earnings. Yeah, so momentum is deteriorating, but on May 1st, the momentum was still there. So that's stock forecast toolbox. If you're looking for signals, you can go and look at active trader, weekly trader, and monthly trader. These are the signals that I actually trade in a live trading room. So you can see LRCX. If you don't have exposure to semiconductors, maybe this is the stock to buy on pullbacks. It predicted 297, 299. Obviously, it didn't see the rapid rise in interest rates today. So now you can look, you can wait for, if you think that this level holds 280 in an LRCX, okay, then this is maybe a time to buy LRCX. Or energy, OKE. It's split into price, two levels, right? 88.73 or 91.03, right? So 88.73 is predicted low. Obviously, in case of LRCX, we're significantly lower than predicted low. So you might want to just be careful and look your own analysis. Like you can draw this line and say, okay, you know what? It probably 280 holds, so I'm going to buy LRCX. Okay. And in case of OKE, predicted low 88.73, you can say, okay, it's probably not going to get to 88.73 today. Interest rates are up, oil is elevated. Okay, maybe it makes sense for me to buy it at 91.42, 91.03. So you have strategy A and strategy B. I encourage you to split the trades into two, where at each entry point, you only risk half of your position. And each position, the goal is not to risk more than 2.5% of your portfolio. Right, so up to 4 positions at a time, 2.5%, especially when you start trading. If you have LRCX, we do have Elite Circle where actually I trade these signals. This week and last week was Qualcomm. So I'm still managing Qualcomm. I know some of you joined because we have a Qualcomm position. So Qualcomm, I did this week. So I bought emerging market today in the live trading room. I bought emerging market. I closed emerging market. This is one of my positions that I trade around, right? The question is, okay, if 30% of your portfolio in cash, what do I do with the rest of the money? You can be conservative, buy consumer staples, so you can be aggressive and buy, emerging market. I decided to be a little bit more aggressive than usual. I closed JEPQ position and kind of rolled it into emerging market and QQQ. So I bought at 66.76, closed at trim at 67.36, 67.73, and then bought again today at 64.83. And then if you look at the Qualcomm this week, so this is a premium portfolio, right? So in the premium portfolio, I trade spreads. You get one signal every week. This week was Qualcomm. Last week was Cisco. So I did buy Qualcomm 205, 210 call spread at $3.30. It's trading at $2, and it expires today. So I have to make sure that I don't get a sign on this stock. So ideally, it closes at 210. Where's Qualcomm now? $205. So ideally, it closes at 210, right, or 207.5. And then this trade would be profitable, right? But there is a lot of overhead resistance at 210 strike. So I sold 207 and 2.5, 212.5 call spread to hedge my portfolio, to hedge this trade for $1.50. So now I think Qualcomm, if you look at the Qualcomm positioning, and this is day trading, right? Because I have to open and close position same day. It requires $25,000 in your account, even though I think they're starting June 1st, the day trading pattern rule is being kind of obsolete, so they're removing. But still, day trading, you need to have $25,000 in your account. But since I'm managing this position, you can see you have very high position at 279,000 contracts. Actually, small volume. Most of the volume is at 205. So people are fighting for 205, and then the next level is 207. Right? This is where high volume, high open interest. So most likely it's going to just stay between 205 and 210. I mean, it was as low as 200. I mean, you do have very high open interest at 200, but volume is low. Most of the people are now fighting for the 205 level. Any questions? So that's an example of live trading room. You get access to morning bell and closing bell. You have access to recording in case you cannot make it live. And then in a trader log, you can type in SMS, your phone number, your Discord ID, and you will get messages, right? Today I did Qualcomm. I'm concerned about the portfolio. I mean, interest rates. Most of my positions are bullish. I mean, a lot of them are, some of them are spreads, but most of them are stock. So I did buy a QQQ put spread, right? This would be another way to hedge your portfolio. So I bought 686.60 put spread for $3.60. You know, if the market continues to go higher and QQQ holds 700 and SPX holds, you know, 7,300, 7,400, okay, I'm going to lose money on this position, but I'll make money on QQQ, on emerging market, and some of the other positions. Just to make sure I understand, did you say you put your 30% cash in EEM? No, I have 30% of my portfolio is in cash, right? I'm concerned about interest rates. So right now, based on my risk tolerance, I'm 30% in cash. My father-in-law, who is a little bit older than me, I put, you know, I think 40%, 45% of his portfolio is sitting in cash, money market fund. Then, you know, options position, maybe 10 to 20% of my portfolio is in option positions, right? So then what do I do with the rest of the 50%? So I have maybe 20% in QQQ, 20% in emerging market, which is aggressive, right? That means 40% of my portfolio or 30% of my portfolio is in QQQ and emerging market, which is, unless you have high risk tolerance level, I would not do that. You know, we talked about JEPQ, right? That pays you dividend, and it's actually on the downside, it's outperforming. So you can say, Vlad, I like that 10% dividend. I don't care that it's underperforming, right? But I want that steady cash flow. And on the way down, I don't want to be down as much as, you know, the rest of the market. Then you stay in JEPQ. I mean, most of our subscribers are very aggressive and active traders. So they don't like kind of nice and slow. But a lot of people do like nice and slow. So in my father-in-law, I keep JEPQ. In my portfolio, I keep QQQ because I'm more aggressive, and I think there is still more momentum to the upside. If you think we're going to reach the peak, and we're probably not going to go that much further, yeah, sell and main go away, then I think JEPQ is a little bit more conservative. Do I still have JEPQ? I sold most of my JEPQ position. Well, in yellow tunnel, I don't have it. You can look at my positions and type in JEPQ. I sold it because I bought QQQ, right? In the last 60 days, you can see JEPQ. So I closed my entire position at 59.31, and then I rotated into emerging market. You know, so that's so I rotated into emerging market, right? I've been trading around that position, and then I also put half of that JEPQ position in QQQ, right? So I bought it at 693. I trimmed at 705. You know, now it's at 711. So that was my thought process. On J Shop and BSX, Shopify got beat up after earnings. That's a bad looking chart, right? I mean, I would short this stock, even though I like Shopify stock. So maybe it's too late to short it, but the chart is broken, so I would not go long. If you want to day trade or be aggressive trader, you do have a lot of overhead resistance at this level, right? 110. I mean, you can trade anything, right? But you can say, okay, this is support, this is overhead resistance, and you just trade in this channel. BSX, model likes some of the healthcare stocks. It got destroyed right after the earnings. Same thing. It's a broken chart, no matter how you look at it. So I would not invest in it. I would not have it as a long-term position. But if you want to do short-term aggressive trader, you can do it. But I would do it on something that is more liquid than BSX and Shopify. With 10-year yield above 4 and the dollar rising, do you think there is likely to be a meaningful pullback in risk assets? That is $1 million questions, BJ. Right, let's recap. Great question. So rising interest rates, rising inflation, will there be a meaningful pullback? The consensus is no, at least short term, right? That we're not. But it's a lot of it is data driven, right? And a lot of it has to do how long the Strait of Hormuz is going to be closed and how long the crude oil is going to be, at 100 level. And that time frame is shifting, right? When the war started in March, people say, well, if it's going to be April and we're at 100, market is going to collapse. Then they said, okay, if it's May and at 100 or 150, it's going to collapse. I actually asked the Grok this question here. Right? Why the 10-year yield is up today, 2%. And it had a good explanation. High inflation data, hangover, elevated oil prices, right? Reinforcing sticky inflation, potentially a rate hike, right? And it did say, maybe last time I asked, but it did say it just depends on the duration. Now it said end of June, right? Then I've heard end of September. So that is what nobody knows. If the interest rates are going to get to the 5%, I think the pullback is going to be more meaningful, right? We're already at 460. Next stop is at 480. If we're going to stay under 480, I think we'll have a pullback, probably shallow pullback. But if we're going to get above 480 to a 5%, I think we will have a bigger pullback. Will we get to 5%? I don't think so. But again, crude oil, at least as of right now, crude oil, the assumption was that crude oil is going to be at 200. If the Strait of Hormuz is going to be closed by end of May, crude oil is going to be at 100, 200 or 150. So people overestimated that, right? So now the question is, if they stay at 100, probably a shallow pullback. If eventually they rise to 200, yes, pullback is going to be significantly high. And right now, nobody knows. All right, guys, that's all I have for today. Thank you very much. Have a great day. Try our services. You can always sign up, go to pricing, see if Elite makes sense for you, or Premium, or our tools where you get picks and tools. And I will see you guys next week, same time. Thank you very much for participating, and I'll see you shortly. We have a lot of people today, so I appreciate it. Michael, Renata, Bill, DJ, Andre, thank you.